This is Terrence Andre Banks with Information Age Financial Solutions, coming to you with an article we got from Real Investment Advice, and again in the state of the pensions. And as time continues to continue on about this, I've talked about this in nauseam about how important the pensions are and how the problem is just only continuing to get worse, especially with so many people being unemployed and revenue not coming in from taxes alone, as well as other things that's just businesses closing and everything else. This having a huge effect on pensions. And I'm just going to kind of dive into an article, put a link inside the description. Worth your attention. It's worth your attention because of just the importance of it. In 2017, I wrote an article discussing the unavoidable pension crisis. At the time, most did not understand the risks. However, 2 years later, the unavoidable pension crisis has arrived. To understand today, we need a quick review. Currently, many pension funds like the one in Houston are scrambling marginally lower return rates, issue debt, raise taxes, or increase contribution limits. The hope is to fill the gaping holes of underfunded liabilities in existing plans. Such measures, combined with an ongoing bull market and increased participant contributions, will hopefully begin a healing process. Such is not likely to be the case. The problems are not something born of the last financial crisis, but rather the culmination of 20-plus years of financial mismanagement. In April 2016, Moody's and analysts pegged the total 75-year unfunded liability for all state and local pension plans started at $3.5 trillion. That's the amount not covered by fund assets, future contributions, and investment returns ranging from 3.7% to 4.1%. Another calculation from American Enterprise Institute comes up with $5 trillion, presuming that the long-term bond yields an average 2.6%. With employee contribution requirements extremely low, the need to stretch for higher rates of returns have put pensions in a precarious position. The unfunded status of pensions continues to increase. It does a great job showing charts here, which I love. The crisis is here. Since then, the situation has continued to worsen, as noted by Aaron Brown in 2018. Today, the hard stop is 5 to 10 years away, with career plans of current officials. In the next decade, and probably within 5 years, some large will face insolvency. We're already there. Here was a key sentence in Brown's commentary. So a lot of it gives back data as well. The next phase of public pension reform will be likely touched off by a stock market decline, which we have had. Such creates the real possibility of at least one state fund running out of cash within a couple of years. The math says that tax increases and spending cuts cannot do much. Brown was right, and the COVID-19 pandemic has likely triggered a rolling pension collapse over the next couple of years via the NYT. Now, of course, pandemic have it ticking faster. Already chronically underfunded pension programs have taken huge hits to their investment portfolios over the past months as the markets collapse. The outbreak has also triggered widespread job losses and business closures that threaten to wipe out state and local tax revenues. The 1-2 punch has staggered these funds, most of which are required by law to keep sending checks every month to about 11 million Americans. Overpromise, undeliver. Here's the real problem. Moody's Investors Service estimated that state and local pension funds had lost the $1 trillion in the market sell-off that began in February. The exact damage is hard to determine, though, because pension funds do not issue quarterly reports. At the end of the year, we will find the true extent of the damage. However, this is not and has not been a real plan to fix the underfunded problem. Hope for higher returns or sustained returns continues to be the only palatable option. However, target returns have continuously fallen short of objective goals. Quarter returns for all the public pension plans. To wit, over the past decade, public pensions have ramped up stockholders and other risky investments to meet aggressive returns targets that are average around 7%. For the 20 years ending March 31st, public pension plan returns have fallen short of that target, however, returning a median 5.2% according to Wilshire Tucks. While state and local governments are all want to ignore the problem, it isn't going away. There's a simple reason why pensions are in rough shape. The amount of owed to retirees accelerates faster than assets to have on hand to pay these future obligations. Liabilities of the major U.S. public pensions are up 64% since 2007, 64%, while assets are up 30%, according to the most recent data from Boston College Center for Retirement Research. Look at this. Liabilities, they got the charts, and go, just not keeping up. More importantly, there is nothing that can or will change the two existing problems which have plagued the economic shutdown, exasperating pensions. Problem one is demographics. I can't talk enough about demographics. Demographics moves populations, and controls economies. With pension funds already wrestling with largely underfunded liabilities, demographics are another problem as baby boomers age. The number of pensioners has jumped due to longer lifespans and a wave of retirees over the past decade, while the number of active workers remain relatively stable. Great job of showing the charts here. And you can see how the active workers and the retirees, just fantastic how the numbers are. Employment as of 25 to 54 age range in labor force. The problem compounds is that the labor force participation for the prime age working group of 25 to 50 years old declines due to economic shutdowns. At the same time, companies are forcing the over 65 participants to retirement. These individuals are immediately able to start taking pension distributions. Again, charts show a lot. We also have a fertility problem. One of the primary problems continues to be decline the ratio of workers per retiree as retirees are living longer, increasing the relative number of retirees and lower birth rates with corresponding number of workers, such as due to two demographic factors: an increased life expectancy coupled with a fixed retirement age and a decrease in the fertility rate. People are not having as many kids, which then messes up the formula. It works that we have more people on the back end being able to take front end to take care of the back end. In 1950, there were 16 workers per Social Security retired. By 2015, the support ratio dropped to 3 to 1, and by 2035, it's projected just 2 to 1. The population is aging. You can see that. Number of workers per Social Security retiree is falling. As discussed previously, the problem is that while the baby boom generation may be heading towards retirement years, there was little indication they were financially prepared to retire to wit. As part of its 2019 Savings Survey, First National Bank of Omaha examined Americans' habits, behaviors, and priorities when it came to saving, monthly spending, and retirement planning. The findings showed that nearly 80% of Americans live paycheck to paycheck. Many have now been asked to retire, which means they cannot collect unemployment benefits. They are also permanently removed from the labor force. Such is particularly problematic for pension funds because this will lead to an immediate demand for payouts at a time when the pension fund's assets decline. Unfortunately, the ultimate burden will fall on those next in line. Problem 2, markets don't compound. The biggest problem is the computations performed by actuaries. The assumptions regarding current and future demographics, life expectancy, investment returns, levels of contributions, or taxation and payouts of beneficiaries, among other variables, consistently turn out wrong. Usually, faulty assumptions is the linchpin to the inability to meet future obligations. By overestimating returns, it has artificially inflated future pension values. However, high expected returns are required to reduce the required contributions to the pension plans. There is a significant difference between actual and compounded. 7% average annual rate returns. The market does not return an average rate each year, and a one negative return compounds in the future shortfall. Forward projections are a function of expected return values due to rising deficits, valuations, and demographics. You see this chart here again. With pensions still having annual investment returns assumptions ranging between 6 to 7%. Now, I remember it was high as 8% at one time, but they got a little lower. Will likely be another year of underperformance. As noted, pensions do not have much choice but to hope for high returns. If expected returns decline by 1 to 2 percentage points, the required contributions increase dramatically. For each point of reduction in assumed return rate, pensions require a roughly 10% increase in contributions. For many plan participants, particularly unionized workers, increasing the contributions are difficult to obtain. Pension managers must maintain better than market return assumptions that require them to take on more risk. Guiding down. But therein lies the problem. The chart below is S&P 500 total return from the 1995 to present. Projected returns use variable rates of market returns with cycling bull and bear markets out of 2060. I have also adopted more objective projections of 8%, 7%, 6%, 5%, and 4% average returns from 1995 out to 2060. I made some estimates for slightly lower forward returns due to demographic issues. Given the real-world assumptions, pension funds should lower their return estimates to roughly 3 to 4% to potentially meet future obligations and maintain some solvency. Look at this chart here. It's amazing. It requires 30 to 40% increase in contributions by plan participants they simply cannot afford. Given many plan participants will retire long before the year 2060, there simply isn't enough time to solve the issues, and the bear market is already further crippling plans' abilities to meet future obligations without massive reforms immediately. Government bailouts, such as why municipalities across the country have been lobbying the democratically controlled Congress to pass another funding bill to provide financial relief. The bill passed by House Democrats specifically included the following. The cornerstone of the 1,800-page bill is $875 billion for state and local governments. Unfortunately, $875 billion is a drop in the bucket. The real crisis comes when there is a run on pensions. With a large number of pensions already eligible for their pension, the next decline in the markets will likely spur the fear the benefits will be lost entirely. That's well said. The combined run in the system, which is grossly underfunding at a time when asset prices are declining, will cause a debacle of mass proportions. It will require a massive government bailout to resolve it. This is why the Fed is terrified of the market downturn. The pension crisis is the weapon of mass destruction to the financial system and has started ticking. Pension plans in the United States have a guarantee by a quasi-government agency called the Pension Benefit Guaranty Corporation. The reality is the PBGC is nearly bust from taking over plans following the financial crisis. The PBGC ran out of money in 2025. Moreover, its balance sheet, again, they said that will run out of money in 2025. That's 5 years from now. Moreover, its balance sheet is trivial compared to the multi-trillion-dollar pension problem. We're out of time. Currently, 75.4 million baby boomers in America, about 26% of the U.S. population, have reached or will reach retirement between the age between 2011 and 2030. So we're way past that, 10 years before they reach the peak in that manner. Based on this calculation here, many of them are public sector employees. In 2015, study of the public sector organization, nearly 50% of the responding organizations stated they can lose 20% or more of their employees to retirement within the next 5 years. Local governments are particularly vulnerable. A full 30% of local government employees are at least 50 years of age in 2015. It's now at 5 years later, and the problems are worse than before. It is no surprise that public pension funds are completely overwhelmed, but they still do not realize that markets do not compound at an annual return of 7% annually. Such has led to the continued degradation of funding levels as the liabilities continue to pile up. If the numbers above are right, the unfunded obligations of approximately $5 to $6 trillion, depending on the estimates, will have to set aside today, such that the principal and interest will cover the program shortfall between tax revenues and payouts over the next 75 years. That isn't going to happen. The unavoidable pension crisis has arrived, and the consequences will devastate many Americans depending on their retirement pensions. Demography, however, is the destiny for entitlements, so arithmetic will do the meddling. George Will. Whatever amount you are saving for retirement is probably not enough. This article I read pretty quickly. Definitely, you got to spend some time really understanding this problem. And it affects so many of the population who actually have access, and they were born during the greatest economic time that we've ever had. If this video has been any value to you, please subscribe, leave some comments, hit the like button. And until my next video, I'm out.